Welcome to the Deep Dive. This morning, we are stepping into a market environment that feels, well, less like a smooth opening.
And a lot more like a high-tension political thriller.
Exactly.
Yeah.
We're here to unpack the fallout from a weekend where Washington effectively threw two massive policy shocks right at the foundation of the U.S. financial system.
That's the reality you're facing today. I mean, the U.S. market closed out 2025 with really resilient growth, and we've seen a robust start to 2026. The urgent question now is, are these political Molotov cocktails, as analysts are calling them, going to derail that underlying bullish narrative?
Right. Is this risk structural or is it just episodic noise?
Exactly.
That's our mission today. We need to filter out all this high-volume political noise from the critical signal and really unpack the immediate impact on indices, on treasury yields, financials.
And figure out where the actual opportunities might lie in this sudden rotation trade we're seeing.
We got to compartmentalize these shocks, right?
We have to. We're dealing with two major threats. One is, you could say, existential to the independence of U.S. monetary policy.
And the second?
The second is a direct, tangible assault on corporate profitability, coming just hours before Q4 earnings season officially kicks off.
Okay, so let's start where the magnitude is greatest. That macro shockwave hitting the Federal Reserve, this action is, it's truly unprecedented.
It is.
Can you just detail the move? The Department of Justice served grand jury subpoenas threatening criminal charges against Chair Powell.
Ostensibly over something as mundane as building renovations.
Right.
But what's fascinating here is how quickly that narrative shifted. It went from procedural legal matter
to political intimidation.
Instantly. And Powell didn't wait. He released a rare video statement, which is a highly unusual move for a Fed chair, and he pushed back hard.
What did he say?
He accused the administration of applying political pressure and intimidation, saying this move is a consequence of the Fed setting interest rates based on economic evidence, not
on the policy preferences of the White House.
Precisely.
So you have the DOJ, which is typically focused on law enforcement, using this minor administrative thing to question the core independence of the central bank.
That's the real story here. The institutional integrity is what's being tested.
And that immediately translates into some severe long-term political uncertainty.
In Congress, yeah. The friction was immediate. Senator Tillis, a key Republican, he pledged that he would impose the confirmation of any Fed nominee.
Any nominee.
Any nominee, until this legal matter with Powell is fully resolved.
And just tell the listener why that one senator matters so much. What does the math look like here?
Well, if you connect the dots, the Senate Banking Committee is currently split 13-11.
Okay.
That means if just one Republican joins the opposition, the committee is completely deadlocked. Without Tillis's support, any nominee the administration proposes just dies in committee.
It freezes the entire replacement process.
It does, which is a critical risk now embedded in every rate decision.
And speaking of freezing things, let's just clarify Powell's status. His term as chairman, that ends May 15th this year.
Right, but he remains a governor. He has a seat on the board until January 31st, 2028.
So this whole legal quagmire might actually give him leverage, maybe encouraging him to just dig in his heels and stay on as a governor.
Which brings us to the market's reaction, which was surprisingly level-headed. Despite the magnitude of this challenge, it wasn't a panic.
No. Equities did pull back from all-time highs. S&P futures were down 0.5%. NASDAQ futures down 0.8% pre-market.
But those losses were muted pretty quickly, and many sources suggested this reflects what's been dubbed the taco trade.
Okay, let's unpack that, because that sounds like market jargon trying to be a little too clever. What is the taco trade?
It's a bit clever. Taco stands for Trump always chickens out.
Ah.
It's this cynical belief, really, that administrative actions that threaten market stability are often pulled back or diluted before they cause any kind of permanent damage.
So traders believe institutional resilience will win out, or that this is just political theater.
Exactly, not policy reality.
But if the market is so level-headed and trusts this taco trade, why are the bond market and inflation hedges just screaming concern? That's a completely different story.
It is. The real signal of long-term concern is in fixed income. Long-end yields are pushing decidedly higher. The benchmark 10-year yield is nearing 4.19%, and the 30-year bond is up 2 to 4 basis points. This reinforces the risk of a steepening yield curve.
Okay, and for the listener, why does a steepening yield curve matter right here, right now?
A steepening curve, which just means long-term debt yields are rising faster than short-term ones, is historically seen as a leading indicator of inflation fears.
Right.
So if the Fed's independence is eroded and it's forced into a, let's say, a structurally more dovish view to appease political pressure,
The market is pricing in that long-term inflation risk right now.
that's it. The bond market doesn't trust the stability of long-term monetary policy.
And we're seeing a similar reaction in currencies and commodities, which kind of act as a release valve.
Yeah.
The DXY dollar index is weaker.
And at the same time, precious metals like gold and silver are climbing to record highs.
It's the ultimate long-term hedge.
It is. So the market may be brushing off the immediate political drama in equities, betting on the taco trade.
But it's hedging that institutional risk through bonds and metals at the exact same time. It's a very conflicted picture.
Okay, so that's the existential monetary policy risk. Now, let's connect that instability to the second bombshell, one that has immediate, quantifiable financial consequences heading into earnings week.
Yes, the affordability push targeting corporate balance sheets.
This was a rapid, targeted strike.
Very. President Trump issued a very clear demand for credit card companies to cap interest rates at 10% for 1 year, and he set a hard deadline of January 20th.
And threatened that failure to comply would result in claims of violation of the law.
Which is a pretty serious threat.
Considering current credit card rates can hover between 25% and 30%, a 10% cap would just fundamentally transform the profitability model of the entire industry. And the market impact was immediate and brutal on any exposed financials. We saw major card issuers get absolutely hammered in pre-market and early trading.
Like who?
Capital One Financial, a major card heavyweight, dropped 6.5%. American Express was down 4.3%. Even the big money center banks like JP Morgan Chase felt that drag, down nearly 3% because of their consumer credit exposure.
So this threat could just instantly wipe out billions in profits,
Yeah.
making big banks the political easy bogeyman right before they're supposed to report strong numbers.
It's a profound paradox. Because banks are actually set to kick off earnings this week, JP Morgan is tomorrow, and BofA, Wells Fargo, Citi later on.
And their Q4 results were supposed to be robust.
Very robust. Sources suggest investment banking commentary is expected to be real good.
Wait, why is investment banking doing so well if the macro picture is so rocky?
It's driven by two factors. Record debt capital markets, or DCM activities, so companies are issuing a lot of bonds, and really robust M&A pipelines. And this activity drives non-net interest income, or NII. For the listener, that's essentially the fee revenue banks earn from underwriting deals, advising on mergers. It offsets weakness in core lending.
So the banks have great numbers to report, but the entire focus of their earnings call is going to be dragged down by this policy uncertainty.
Exactly. Executives will be forced to be policy spokespeople instead of financial experts.
And what about the competitive landscape? This policy threat creates a huge divide.
It does. The pain for traditional card issuers contrasts really sharply with the surge we've seen in buy now, pay later companies.
The BNPL firms are seen as the beneficiaries here.
They are. Because if traditional lenders are constrained from pricing risk, meaning they can't charge high enough rates to cover potential defaults, they'll just tighten credit availability.
And when that happens,
Consumers pivot to alternative financing sources, like BNPL.
shifting gears a bit to the micro-level flows, M&A, the rotation trade, it's not all just Washington noise. We've seen some major moves, starting with a pretty seismic index rebalancing.
This is a massive, tangible flow event. Walmart is joining the NASDAQ 100 on January 20th. It's replacing AstraZeneca.
And the flow impact is huge.
Huge. Analysts estimate this will trigger nearly $19 billion flowing into Walmart stock from all the passive index funds that have to track the NASDAQ 100.
Which explains why Walmart shares were up nearly 4% in the news. And that ties right into that broader U.S. tech and AI narrative, doesn't it?
It really does. Walmart recently solidified its partnership with Alphabet and Google's Gemini platform for AI-enhanced shopping.
So it's this blend of an old retail heavyweight with cutting-edge AI.
Precisely. And outside of the megacaps, M&A is still robust, which signals continued confidence in corporate valuations. We saw activity in the airline sector.
Right, Allegiant Travel acquiring Sun Country Airlines. Sun Country shares surged over 10%.
And in media, the fight for content is getting pretty nasty. The pursuit of Warner Bros. Discovery is becoming hostile.
With Paramount and Skydance launching a proxy battle and a suit to halt Netflix's pursuit.
It's a classic media war over IP and distribution channels.
And if we're looking for where the latent value is, what's the expert consensus?
The consensus is that industrials are ripe for consolidation and carve-outs. They're trading at multiples well below the Mag 7.
The Mag 7 being the Magnificent Seven, the big tech stocks that have dominated the market for the last 2 years. Why is that multiple comparison so significant?
Well, the industrial sector is trading at less than half the multiples of the Mag 7, even though many of them are strong, cash-generating businesses with robust backlogs.
So it indicates that value investors are looking outside that concentrated tech bubble.
Which aligns perfectly with the strongest underlying theme we've been tracking, the rotation signal.
The Russell 2000, representing U.S. small-cap stocks, is the clear leading indicator right now. It's on track for its 7th straight session of gains.
And the continued outperformance of small caps year to date, they're up 6% compared to the S&P 500's modest gains, suggests money is filtering into the broader market, into cyclical stocks that rely on domestic growth.
So we're seeing a broadening of the rally.
We are. And it's driven by the fact that small caps are trading at nearly half the valuation multiples of the Russell 1000, despite showing faster sales and earnings growth. That's a compelling argument for continued rotation into value.
Now, let's broaden the view, because while the U.S. market is grappling with these high-volume domestic political shocks, the rest of the world seems to be taking advantage.
We are definitely seeing the Sell America trade reemerge.
And that's a direct consequence of this U.S. policy volatility.
It is. Non-U.S. markets continue to show relative outperformance fueled by the uncertainty coming out of Washington. When your domestic policy becomes unstable, global investors just view dollar assets as inherently less compelling.
The Asia rally is particularly notable here. Chinese mainland stocks saw the Shanghai Composite hitting 10-year highs yesterday.
Yeah, Asia is increasingly positioned as a safer, less politically volatile alternative to dollar assets right now.
And that's underpinned by real expectations.
It is. MSCI China is expected to see robust 12% earnings per share growth in 2026. This confidence overseas is, it's juxtaposed against increasing geopolitical friction from new U.S. policy.
Specifically, President Trump announcing 25% tariffs on countries doing business with Iran.
And Tehran's top trading partners include massive U.S. partners like China and India.
So that's a direct threat to the fragile U.S. trade truce we had going into the new year.
The implications are widespread. Tariffs disrupt supply chains, they disrupt input costs. And then on the energy front, the president signaled displeasure with ExxonMobil CEO Darren Woods
for labeling Venezuela as uninvestable.
Right, which drew attention to the administration's push to rebuild Venezuela's oil industry. But despite all these headlines and tariff risks, WTI crude remains pretty range-bound near $59 a barrel.
Supported by expectations of an adequately supplied global market.
For now, yes.
So what does this all mean for you, the investor, looking past the next 24 hours? The core tension seems to be investors facing this unprecedented volume of political noise.
That's attempting to interfere with what are arguably still robust economic fundamentals. I mean, we still have resilient growth and a disinflationary environment.
So the consensus view holds?
For now, yes. Markets remain hyper-focused on incoming economic data and corporate earnings. That's the signal. They are largely shrugging off the political volatility. That's the noise.
But the risks we outlined are very real.
They are, particularly that steepening yield curve in the bond market and the immediate tangible profit pressure on all the credit card issuers.
But if we look beyond the day-to-day moves, this drama between the administration and the DOJ has made the already highly contested Fed chair nomination process, virtually impossible.
That Senate Banking Committee deadlock, combined with the legal challenge to Powell, means the next Fed chair nominee is going to struggle immensely to gain confirmation.
Which raises a really fundamental, provocative question for all investors, I think.
It does. Who truly controls U.S. monetary policy if the Senate remains frozen, caught between a political attack and a refusal to confirm?
And Governor Powell decides to just dig in his heels until his governor term expires in 2028.
It creates a long-term shadow over the stability of the dollar and the entire U.S. financial system.
A major point of institutional uncertainty that the market seems to be underpricing right now. For a detailed breakdown of all headlines mentioned today, please check the podcast description.